REITs are surging right now because interest rates are expected to go to much lower levels already in the near term, and as a result, REITs are now up nearly 10% over the past month alone and over 30% since their lowest level in October of last year. This may lead some of you to think that it's now too late to invest in REITs, and I would disagree with that. Yes, it is true that it may now be too late to invest in some of the biggest and best known REITs because those were the fastest to reprice to higher levels. I mean, good examples of that would be Prologis, Ventas, Digital Realty, Agri Realty. However, there are a lot of smaller and lesser known REITs, especially in foreign markets, that today remain very heavily discounted and still offer 50 to 100% upside potential in the coming years as they recover from this REIT bear market. Hey, this is Yus. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss two REITs that I'm buying before interest rates are cut because I expect them to rise a lot higher once interest rates return to lower levels. But before I get into it, I want to remind you that we recently launched our newsletter, High Yield Landlord, on Substack, and there's a bunch of high quality free research there. So if you want to check it out, I'll put a link to it in the description of this video. So the first REIT I'm going to discuss here is called Safehold, ticker symbol SAFE, and this is the only publicly listed REIT that specializes in ground lease investments. In case you're not familiar with ground leases, these are essentially land investments that Safehold owns and then leases on a long-term basis to a tenant that will build a property on top of it. These leases are typically ultra long at typically 99 years, allowing the tenant to build and operate the property for a very long time to come without having to put all the money to pay for the land. Then at the expiration of the lease in 99 years, the building will revert back to the landowner, Safehold in this case, at no additional cost. So ground lease can truly be win-win for both parties here. And if we start with the landowner, so Safehold in this case, it can be a great long-term passive investment in real estate. You don't have to be managing a building, doing repairs, changing tenants. It's quite operationally intensive to own a building. In this case, you just own the land. You earn a relatively low yield at first because cap rates for ground leases are low. But this lease will gradually grow over time according to the lease escalations. And most importantly, once the lease expires, you will own also the building free of charge, which will likely be a lot more valuable in the future than today. This is also typically a very safe investment because if your tenant fails to pay your ground rent, typically they will default on their lease and the property will revert back to you at no cost. And now from the perspective of the building owner, it can also make a lot of sense because by not having to buy the land portion of their investment, they get to increase their returns on equity, the return on their invested capital, and they may not care anyway what will happen to the building in 99 years from now. But the main downside of these investments is that they are extremely sensitive to interest rates because of the ultra-long duration of the leases. Making matters even worse, Safehold has a roughly 60% LTV, which makes it even more sensitive to interest rates. This explains why its share price has absolutely crashed over the past 2 years. In fact, it's been one of the worst performers in the entire REIT sector. But I think that we could now see the opposite happen as interest rates return to lower levels, and if we've learned anything over the past few years, it's that REIT share prices can recover just as fast as they drop. In fact, the company's share price has already risen by about 30-40%, but if you zoom out a bit, you'll see that this can really just be the start. Even if the share price doubled still from here, it still wouldn't reach its peak value of 2021. And so that really shows you how heavily discounted it is and how much upside there would be because this is very sensitive to interest rates. And the debt market is now predicting that interest rates will come down about 200 basis points over the next year. And I think it's inevitable that this will help the market sentiment of Safehold and lead to a much higher valuation. And so if you agree with me and think that interest rates are likely to go to lower levels, then I think that Safehold is a great pick at this moment. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button? That helps me a lot to keep producing all this free content for you. Thanks so much in advance. And so the second REIT that I'm going to discuss, I think I've never mentioned on this channel before, is called Northwest Healthcare Properties REIT. This is a REIT that specializes in hospital net lease property investments, just like Medical's Property Trust, which you might be familiar with. And from that REIT, you probably know that this is a sector that suffered significantly following the pandemic, and to this day, it's avoided by most investors. But the portfolio of Northwest is actually mostly outside of the US. It's very well diversified geographically. It has properties in Canada, in the US, in Europe, in Latin America, even in Australia. And its properties are doing very well, much better than those of Medical's Properties Trust. Last year, its same property NOI grew by 4%, and it's guiding to grow it at a similar rate again this year. However, the company has still greatly suffered over the past 2 years, and that's because of two key reasons. Firstly, it came into this rate hiking cycle with way too much leverage, and so that naturally was an issue. And then secondly, the poor market sentiment for hospitals has caused its equity to drop significantly, and this derailed its growth prospects. The management's reaction to this was to transform from a traditional REIT into an asset manager in order to raise private equity, deleverage the REIT, accelerate its growth prospects, earn fee income, and create value for shareholders. And so far, the REIT has made great progress on this front. It has sold about $1.5 billion worth of properties at a 6.5% cap rate, which is quite attractive. I would have expected them to sell at higher cap rates given the environment we're in, and it used these proceeds to pay off some of its near-term debt maturities. It's also actively creating new joint ventures in which it's actively selling equity interest to other institutional investors to raise equity, pay off more debt, and earn fee income for shareholders. This is all great progress, but if you look at the share price of the company, you will see that it's still very heavily discounted relative to its peak, and rightfully so in some ways because it's still really struggling, let's face it. They still have a lot of debt. A lot of that has variable rates, high interest rates, and so it's really still feeling the pain of the significant rate hikes of the past years. But I think that we could now be at an inflection point and things could turn for the better in the near term. Currently, the average interest rate of the REIT is in the high 5s, it's nearly 6%, and so now getting much lower interest rates in the near term should really go a long way for this REIT specifically. I think that the lower interest rates will also make it easier for the company to keep on selling assets at relatively attractive cap rates because it will lead to a recovery in the transaction volumes. And so the risks remain relatively high here, especially, if you look at the debt maturities, you'll see that it has significant maturities in 2025. But the interesting thing here also is that the interest rates of the debt maturities in 2025 is nearly 7%. And again, historically, it's been able to sell properties with cap rates even below that. So if we now assume that interest rates return to lower levels, the company closes more asset sales, pays off this debt, that would increase its FFO per share despite selling the assets because the interest rates on the debt is higher than the cap rates of its assets. And as this happens now, I think that it's going to greatly benefit the market sentiment, and there's significant upside here because the latest NAV estimate of the REIT is nearly $10 per share, and that's down significantly from its peak. It was in 2022, it was at nearly $14 per share. And yet the share price today is just around $5. So there's a huge discount to its net asset value for good assets that are enjoying growing NOI. But yeah, the main issue is the debt. It's concerning the market, rightfully so. But as interest rates now return to lower levels and they sell more assets, I think that it's really going to go a long way for this REIT specifically, and it could lead to significant upside as you remove these concerns of the market. So these are two examples of REITs that could easily surge another 50% as interest rates return to lower levels, but there are many more such REITs, and that's in what we are investing at the moment as we're positioning our portfolio to maximize gains in the recovery of this bear market. And if you want to access our full real money REIT portfolio, you can join High Yield Landlord for a 2-week free trial. I'll put a link to it in the description of this video. As I've said before, this is a real 2-week free trial. You won't be charged anything in the first 14 days, so you can come in, read our research, access our portfolio, see if it's something that could make sense for you, and if it's not, you can just cancel. You won't be charged anything. Finally, if you thought this content was valuable, I would really appreciate if you click the like button and subscribe to the channel. That will help me a lot to keep on growing. Thanks so much. See you at my next one. Bye-bye.